Ranked as America's 25th richest hedge fund manager in 2020, William Bill Ackman boasts a current net worth of over $2.2 billion. Ackman is a famous American philanthropist, investor, and hedge fund manager, but best known as a founder and CEO of Pershing Square Capital Management. Since he is most known for being an activist investor, it would be a surprise to some people that Bill actually uses some value investing principles. Activist investing is often both controversial and confrontational, so it generates a lot of press interest. That usually leaves the value investing part of his system in the background, but that does not mean it is less critical. Unlike other funds, which simply invest, hoping that shares will increase in value, Ackman actively pushes for change at companies Pershing is invested in. The investor became well known in the financial world for his short position on bond insurer MBIA and his accomplishment from mall operator General Growth early on in his trading career. But we could say with certainty that Bill Ackman's career has been a roller coaster over the last several years. He became a billionaire through operating the Pershing Square Capital Management hedge fund that he founded in 2004. Still, over half a decade, he went from being one of the most well-regarded hedge fund managers in the industry to having a string of well-publicized failures as a result of shorting Herbalife and betting on Valiant. Luckily, he has managed to recover, and nowadays, Ackman has an army of highly trained quants, computer algorithms, analysts, and skilled people on his side to do the calculations. However, he is the brain behind each operation. This is why today we're here to see how Bill Ackman evaluates a stock. According to Bill Ackman, the best businesses are simple and predictable. Besides, these businesses produce large amounts of free cash flows. This means that Ackman opts for companies with economic moats that are durable competitive advantages and make it hard for competitors to unseat them by simply copying their product. One classic example of a company with a vast moat is Coca-Cola Co. Even though it's not very difficult to make sweet carbonated water, Coke is valued at orders of magnitude higher than a generic soda company. Just as Warren Buffett's Berkshire Hathaway, Ackman's Pershing Square seeks out high-quality businesses. These are expected to thrive for a long time and continue producing large quantities of cash. Any investor, no matter how conservative, needs to make certain assumptions about the future. You need to have some level of confidence that the business you are buying will continue to generate cash while you hold it. And so it helps to have a predictable and straightforward business rather than something where the prospects are less clear. If the value of any asset is the amount of cash that asset will produce throughout its useful lifetime, the long-lasting businesses have something going for them. This is also why predictability is so important. The asset needs to be durable, but it also needs to be reliably productive. After the value is accurately assessed, an investor only needs to see whether the asset is trading at a lower price. If so, he then needs to find out what the reason for this discrepancy is. If the reasons aren't disqualifying, then it's worth the investment. This type of philosophy applies to any capital allocator, not just a billionaire activist investor. Bill Ackman believes investors should look at making investments keeping a long-term perspective in mind, which would help eliminate the fears of getting caught up in short-term market volatility. For investors who have a long-term view, buying a stock and experiencing a loss over the short run should not be a concern. So if the company's financial outlook suggests that it continues to be a sound investment, it would be pretty irrelevant how it performs over a matter of weeks or months. He stated, "Short-term market and economic prognostication is largely a fool's errand. We should invest according to a strategy that makes the need to rely on short-term market or economic assessments largely irrelevant." According to him, a successful investor must retain a fine balance between confidence and humility. So it's okay to go against the herd and look silly to many, as it takes a while for the market to catch on. Warren Buffett states value investing is like vaccination. Either you get it right away or you don't. Value investors use structural analysis as part of the value investing system to decide when to make a bet about whether something will happen, so they do not fool themselves into believing that they can anticipate when that happens. People who are not famously immunized into value investing often can't see the difference between waiting opportunistically for something to happen and attempting to foretell when something will happen. Waiting opportunistically for something to happen is not predicting. Arguments that the unchanging assumptions that underlie value investing are predictions are a rhetorical sideshow. If you don't understand the patiently waiting, then opportunistically pouncing rather than predicting element to value investing, you won't ever understand value investing. Sometimes bets turn out to be wrong, and they can create catastrophic failure if they are not adequately risk managed. But bets like this one are not daily, weekly, or yearly decisions. They are made only a few times over a lifetime. According to Ackman, there will always be ups and downs in the investment world, and even the most successful people in the world have significant failures from time to time. What makes them unique and successful is their ability to bounce back from adversities. So, however challenging the times might be, Ackman advises investors to hang in there and patiently wait for better times to come. One of the principles of value investing is to manage a share of stock as a comparative interest in a business. A share of a stock is not a piece of paper to be traded based on what you think others will think or about what others will think about the value of a piece of paper. To be prosperous at value investing, you need to understand the actual businesses in which you invest. Ackman advises investors to conduct proper due diligence before making any investments. You can do this by reading about great value investors and following their investment philosophies, or watching their videos and listening to their words of wisdom. Reading is a good habit to learn new things. Ackman believes that before investing in a business, it is essential to understand that business thoroughly. A successful investor needs to possess the necessary skills of distinguishing between a great business, a good business, a fair one, and a lousy one. Find a business that you understand, has a record of success, makes an attractive profit, and can grow over time. Emotions only impede your chances of making profits. However, it's definitely challenging to ignore emotions in any market situation. Ackman insists that he is not emotional about investments, and according to him, investing is something where you have to be entirely rational and not let emotion influence your decision-making, just the facts. An easy way to help accomplish this goal is to establish an investment checklist that can include a range of facts and figures. Company debt levels, interest coverage, and valuation metrics must be sufficiently analyzed before investment. They drive an investor to examine fundamentals when making any decision concerning their portfolio. Companies that do not meet the requirements listed in a checklist may prove to be unattractive. Avoiding them may lead to more productive use of capital in the long run. Market volatility can panic some investors, and they can become nervous about the probabilities for their portfolios. Ackman advises that investors ignore their emotions and use logic when evaluating stocks instead. Another bedrock principle of value investing is the margin of safety, which is a discount to an intrinsic value that should be significant to be effective. Back in 1994, Buffett wrote to Berkshire shareholders that inherent value could be described simply: it is the discontinued value of the cash that can be taken out of a business during its remaining life. What creates a margin of safety is buying at a significant discount to intrinsic value. If you have a margin of safety, you don't need to accurately predict intrinsic value, which is a slightly obscure concept that different people calculate in somewhat different ways. This explains Bill Ackman's use of the phrase reasonable band of outcomes. The critical thing about intrinsic value is that you only need to be approximately right rather than precisely wrong. If you wonder how much time you would need to spend on evaluating a stock, Ackman's answer might surprise you. Namely, in one of his numerous interviews, he stated that one of the best decisions he ever made only took 4 hours. This occurred when Pershing Square acquired a 42% stake in financial services company called Wachovia Corp. Citigroup had agreed to purchase the banking subsidiary of Wachovia, leaving the holding company intact. This holding company still had a sizable amount of cash and securities on its balance sheet and a strong wealth management business. Wachovia's stock had halted while the Citigroup announcement was being made. During those 4 hours, Ackman and his team went through the Wachovia's 10K and determined that the holding company was worth between $11 and $14 per share. After the announcement, the stock opened at $1.84, giving them a chance to build up their 42% position. This is an example of the type of analysis that can be done by any investor willing to put in the work. Be sure to comment down below and let us know if we've missed something. Hit that subscribe button and turn on the bell to never miss an upload. Thank you very much for watching.